Welcome to this explainer. If you've ever looked at the stock market and thought you absolutely needed a stratospheric IQ, secret insider information, or honestly, just blind luck to succeed, well, you are in the exact right place today. We're going to uncover how building real wealth actually requires something entirely different. It's about a structured intellectual framework and rigorous emotional discipline. We're breaking down Benjamin Graham's foundational philosophies from The Intelligent Investor and uncovering the exact mechanics that have driven some of the most successful portfolios of the last century.
Let's kick things off with a pretty massive endorsement from Warren Buffett himself. As a direct disciple of Graham, Buffett literally calls this, by far, the best book on investing ever written. And let's be real, when someone with Warren Buffett's track record gives an endorsement like that, it's a giant flashing neon sign telling us we need to pay very, very close attention to how this framework operates.
So, what's the crucial takeaway here? It's that emotional discipline is strictly greater than a stratospheric IQ. The core premise of Graham's entire philosophy isn't about being a math genius. It's not about getting lucky. It is about building a rock-solid decision-making framework and rigorously keeping your emotions in check. Think about it. If you can just control your impulses when the rest of the market is either completely panicking or throwing a massive party, you already have a huge edge over the competition.
Okay. Here's our roadmap for today. First, we'll meet the infamous Mr. Market. Then we'll explore two distinct paths, the defensive investor and the enterprising investor. After that, we'll look at your ultimate shield, the margin of safety. And finally, we'll redefine how you look at risk versus reward.
Let's dive right into Section 1 and meet our erratic antagonist, Mr. Market.
Picture this. You bought a piece of a business for $1,000. Now, every single day, this highly erratic, totally bipolar character named Mr. Market knocks on your front door. He tells you exactly what he thinks your share is worth, and he offers to either buy it from you or sell you more. But here's the catch. His opinions are often pure gibberish. He swings wildly from insane optimism to deep, dark pessimism. Just look at the absolute madness of March 2000. Mr. Market was euphoric, shouting that your share was worth $2,600. But skip ahead just 1 year to March 2001, he was profoundly depressed, claiming it was only worth $500. Now here's the crazy part. During that exact same 1-year period, the actual company's income went up by 50% and its profits surged by a very real 20%. The underlying business was literally thriving, yet the asking price was slashed by over 80%. What does this teach us? A stock is not just a blinking ticker symbol. It's an ownership interest in a real business. You can never let Mr. Market's wild mood swings dictate the true value of your investment. You don't have to trade with him, you just have to capitalize on his bad math when he happens to offer you a bargain.
What's really fascinating to think about is the contrast between our world today and the era when Graham actually wrote his book. Back in the 1970s, Mr. Market basically visited you just once a day, right? You opened the morning newspaper, checked the numbers, and moved on with your life. Today? Oh man, Mr. Market lives right in your pocket. He interrupts you on your smartphone over 100 times a day, constantly demanding an emotional reaction with push notifications and flashing red and green numbers. But you have to remember this. Just because he visits you way more often doesn't mean you have to trade with him any more frequently. If his offer doesn't meet your standards, simply ignore him.
Moving right along to Section 2, the defensive investor and building your foundation.
Look, if you don't have the time or, honestly, the emotional energy to battle Mr. Market all day long, the defensive strategy is this incredibly powerful automated shield. And the foundation for it is beautifully simple. It's just a 50-50 split between stocks and bonds. This ratio acts as your anchor. Now, obviously, as the market moves, this balance is going to shift around. If stocks have a massive run and suddenly make up, say, 60% of your portfolio, what do? You simply sell some stocks and bonds to restore that 50-50 balance. And you only do this once or twice a year. If you combine this with regular, disciplined dollar-cost averaging, meaning you invest a fixed amount like clockwork right after you get your paycheck, you basically ensure you never concentrate all your buying at the absolute worst possible time.
Now, if you do want to pick individual stocks for that 50% equity chunk of your portfolio, Graham lists 8 incredibly strict criteria to ensure your safety. We're talking adequate diversification across 10 to 30 companies. They need to be large companies with over $100 million in sales, conservatively financed with a current ratio of at least 200%. He demands a 20-year history of uninterrupted dividends, 10 straight years with no earnings deficits, steady earnings growth, and strict limits on the price. No more than 1.5 times the net asset value and a PE ratio maxing out of 15. I know, it's a super rigorous checklist, but here's the modern shortcut. If all that looks like way too much heavy lifting and you are totally satisfied with average market returns, you can literally just opt for a broad index fund and bypass this entire headache.
All right, Section 3, the enterprising investor, which is the active path. So what if you thirst for more than just average returns? What if you really want to actively beat the market? Well, to succeed as an enterprising investor, you have to completely, totally ignore the herd. Listen to this quote from a chief investment strategist at a huge mutual fund back in the early 2000s, right at the absolute peak of the dot-com bubble. They claimed it was a new world order and disastrously told everyone that sky-high prices didn't mean high risk. Spoiler alert, yes, the risk was massively higher. Intelligent investors have to remember a very basic fact. Because a company's profits are finite, the price you pay for that company must also be finite.
The crucial point here is that enterprising investors actively avoid those overhyped growth stocks, where the valuation is based entirely on totally unreliable future earnings. Instead, they hunt for rare, deeply undervalued bargains. One of Graham's absolute favorite metrics for doing this is net working capital. You calculate it by simply subtracting total liabilities from current assets. If you can actually find a company trading for less than its net working capital, you are essentially getting all of its fixed assets, the buildings, the machinery, the goodwill, for absolutely nothing. Now, to be fair, these opportunities are pretty rare outside of tough bear markets, but when they appear, they represent a true El Dorado for the active investor.
Moving to Section 4, the margin of safety. This is your ultimate shield.
Whether you're a passive, defensive investor or a highly active, enterprising one, there is one risk no amount of analysis can ever eliminate: the risk of simply being wrong. The margin of safety is how you survive your own mistakes. Think about it like this. Imagine you're constructing a ship, and you know it's going to be used to safely transport exactly 30 Vikings across the sea. Would you design it to hold a maximum capacity of exactly 30 Vikings, knowing that if just one extra, heavy, wet, and angry Viking hops on board, the whole thing sinks? No way. You'd build it to hold 40 or 50. That exact same logic applies to investing. Why on earth would you buy a stock priced at $30 if your careful calculations show it's only worth $31? If your math is even slightly off, your investment completely sinks. You absolutely must demand a large gap between the price you pay and the value you calculate.
Let's put some real-world numbers to this using Graham's own valuation formula. If we take his formula and run it backwards on the stock prices of massive companies from September 2018, we see some staggering discrepancies in what the market was expecting. Just to justify its stock price at that specific time, Amazon would have needed to grow its earnings by a phenomenal 74% every single year for the next 7 to 10 years. Meanwhile, Apple's price required an expected growth rate of just a highly achievable 5.8%. When a stock is priced for absolute perfection, like 74% annual growth, your margin of safety is essentially zero.
Let's wrap things up with Section 5 and take a completely contrarian view on risk versus reward.
Okay, so the academic world loves to tell us that to get a higher reward, you simply must take on a higher risk. Graham vehemently disagreed with this. He argued that risk and reward are not actually correlated when it comes to intelligent investing. To see how flawed this academic theory can be, consider this morbidly fascinating analogy. Imagine you're offered a game of Russian roulette. Step 1, there's one bullet in the chamber, so a 16.7% risk of death, and the reward is $10,000. Obviously, you say no. So, the guy offers Step 2. He adds a second bullet, doubling your risk to 33.3%, but bumps the reward up to $100,000. Academic theory technically says this makes sense. You are demanding a higher potential reward for accepting a higher risk. But in the real world, that is insane logic. You would never take a fatal risk just because the payout jumped. But here's the beauty of intelligent investing. The dynamics are entirely flipped. Because price and value are constantly being disconnected by our old friend Mr. Market, finding a company selling at 40 cents on the dollar gives you a phenomenally higher potential reward combined with a much lower risk than if you bought that exact same company at 60 cents on the dollar. I mean, how could anyone argue it's somehow riskier to buy a dollar for 40 cents than for 60 cents? By insisting on buying bargains, the intelligent investor lowers their risk while simultaneously increasing their potential upside. It literally breaks the academic model completely.
Okay, after exploring this brilliant, structured framework, from learning to ignore Mr. Market's wild mood swings to insisting on a rigid margin of safety, I want to leave you with a final provocative thought to chew on. We've seen exactly how powerful emotional discipline is over raw IQ. But look at your smartphone. Look at the constant, flashing 24/7 news cycle. Are Benjamin Graham's strict rules, crystallized way back in the 1970s, still fully applicable to the hyper-connected, algorithmic, and deeply chaotic markets of today? Or does Mr. Market's modern megaphone mean we need to develop an entirely new kind of discipline? It's a vital question to ask yourself as you build your own automated shields and step into the market. Keep questioning, keep analyzing, and use this timeless framework to structure your own path to financial understanding.